Boy, this market is having a difficult time trying to find its own feet after losing about, 500 points yesterday, another 438 on the Dow today. We're getting confirmation that Morgan Stanley is looking into cutting jobs, maybe 2% of its workforce. The same day Goldman Sachs' CEO is warning about pay and job cuts coming, and a still iffy environment for the entire banking sector. And people, on and on, like Jamie Dimon of J.P. Morgan Chase, saying that inflation is eroding consumer wealth. It may bring on a recession. Then entered this next gentleman who, no offense to these other gentlemen, has been more prescient and more accurate on the overall pace of this economy and its underlying strength, and was saying things that seemed at a lockstep with almost everyone else in the financial industry. Brian Moynihan is the head of Bank of America, kind enough to join us. And Brian, one thing that stuck out in your comments, and I follow you and your colleagues' comments quite closely, was your inherent optimism, and maybe, I don't know if that still holds, about where we stand. You obviously see bumpy times ahead, to paraphrase your recent comments, but you don't see this free fall going on. Explain where you see things going, because it is markedly different than your colleagues.
Well, I think, number one, we have a research team, and they're a very talented group, one of the best in the world, and their view is that we'll have 3/4 of negative GDP growth in the first part of next year. But it's 1.5%, and it turns back to positive towards the end of the year. That would be a definition of a shallow recession, or however you want to characterize it. Frankly, if you go back to when a lot of people were very concerned earlier this spring, they've even pushed out their assumptions that we're going to be at the end of this year to next year. Now, what's driving that? The reality is the unemployment level is still 3.6, 3.7%, 200,000 jobs formed, wages still growing. Doesn't bode perfectly for the inflation side, but shows you that the resilience of the American consumer to spend. They spent 5% more in November across our customer base than they did last November. That rate of growth is slowing, but it's not going off a cliff. And the Fed has raised rates high, and they will hold them here to make sure they get inflation out. But the good news is, with unemployment where it is, with people not laying off mass amounts of people, yes, we're all trimming our jobs and saying, hey, we're going to be more careful, we're going to be more cautious. Why not? Because you believe a recession's coming. But you're not seeing the massive downdraft in numbers of people filing new claims for unemployment. You're not seeing the number of people really laying off people as opposed to trimming jobs or not hiring as many. And so that bodes that we're going to have a shallow recession. Now, there are possible issues outside our country, especially supply chain, Russia, Ukraine, that could change that. But our current experts believe it's a mild recession in the U.S. and then back to growth as it gets towards the end of the year. But the Fed's rate stay high through it into 24, because they need to stay high to make sure inflation is going, because that really works hard on middle-income America, and they need to make sure it's under control, and you're starting to see the signs of that happening.
But you mentioned at the outset, Brian, the strategists at Bank of America, because they're the same group that sees the S&P falling, I believe, 20% from where it is now. What did you think of that?
Yeah. Well, they have their views of the market dynamics and pricing. But when we look at the economy, just to be clear, when I'm giving a statistic of spending, that's a real 35 million consumers that have checking accounts with us, 60 million total consumer customers spending a record amount over the Thanksgiving. And so that's what is real. What the strategists are trying to predict is what happens to the recession over next year. And so I'll let them speak to that. But but the underlying economic assumptions that our economists and others agree is a mild recession. But that's at the end of the day, we got to get inflation under control, and that's what the Fed's trying to do. And so you're seeing the most interest rate sensitive parts of the economy take the hit first. Housing prices, demand for new houses because mortgage rates went up. Likewise, the market, because as leverage comes out of the system, the easy money, the ability to make money comes down, and that's why people are more nervous about their estimates of the S&P over the next 12 months. But be a long-term investor like we are, and it'll work out in the end with the greatest economy and the greatest country in the world.
But your counterpart at J.P. Morgan Chase, Jamie Dimon, has talked about a hurricane winds facing the economy. Some have said we're headed definitely for a severe recession. I think you look at a slowdown in 3/4 next year. So how would you characterize your view of where we're going, especially in light of these stories that have the Federal Reserve maybe continue to increase rates far beyond what we thought, maybe well beyond 5% for federal funds? That's a big wall to climb, isn't it?
Yes, it is, and that's so. In those estimates is the Fed funds rate going up around 5% and staying there really all the way through next year, and then coming down a little bit at the end of next year and into the next year, but 475 to 5% at the end of 23. So this is not a they're going to raise rates, everything's going to be good, and they're going to cut them. They're going to have to grind at inflation for all of 23 into 24, and I think that's what the Fed said a week or so ago when they said, we're going to have the duration of this rate hike. Maybe we're getting close to where we might not have to put up further, but the length of which we're going to hold it here may be longer than people think, and that's what you saw the market react to, not the first day, but the second day, and that's what you're seeing the market react to. That is good commitment to get inflation under control. Meanwhile, if the statistics continue to be fine and you see inflation tipping over, which you're starting to see the signs of, and we'll have to see it play out, then they'll change their posture. But right now, that's their current posture based on their view of inflation through 23. And our economists think the same thing. It's going to take higher rates and to really get inflation under control. Rents have tipped over and started coming down for the last 3 months. They do every year, but they came down more this year. House prices are starting to come down. And so, while there's pockets that are different, it's kind of interesting to see those really rate-driven parts of the economy come down, and we're seeing a softening of demand for commercial credit. We'll still grow at single digits, but a little softer than we saw last quarter. Deposits are holding up. Our consumers have more money. So that's the mix. It's very different this time than the other time because the amount of money that's in the customers' accounts is far higher than it was going into the financial crisis or any other recession as a percentage of what they had before this in the pandemic.
But it is not as high as it was, right? So the fear seems to be you'll start seeing that in real estate applications, mortgage applications, refinancings. I'm just wondering, are you seeing that at Bank of America?
Yeah. So if you think about households in America, it's 130-odd million households total. Half have a mortgage, half don't. They're renters. They own outright, a small percentage. Of the half that have a mortgage locked in, they're fine. It's the people who want to buy a new house that are impacted by this, and people want to sell new houses. So home builders and others are seeing the stress. That is a small part of the overall people in a given year. So people have to remember that that's affecting the house price and what houses may be worth in a sale market or new house being sold, and numbers of new permits, all of which are coming down. But they were running a pretty hot rate, up 19, 20% from the pandemic to now, without population growth. Sort of why is housing stock becoming so much more expensive without any meaningful population growth in the United States? Well, the answer is it was inflation driven, and now they're cutting that back off. That doesn't mean long-term housing is a great fundamental price, and even if it comes down, it'll be in excess of where it was 19, 10, 15%. It'll still be better than it was in 19 when we went into the pandemic.
On crypto, and of course, all the allegations and the problems, with the people who could be, who knows, within a matter of months of years, going off to jail for malfeasance. We don't know where this is going, but we do know people like Jamie Dimon have talked about crypto for the longest time being a sideshow. Does Bank of America think of crypto in the aggregate being a sideshow?
We always believe that there are two parts. That one is the blockchain technology, distributed ledger technology. I think we have 200 or 300 patents in it issued already. And we believe that technology has purpose, and we actually do some things on it now. The idea of a digital currency, we never thought we don't do anything with it. We don't engage in it. We aren't part of it, and we just never thought it was a good idea, and we stayed away from it. And so, you have to separate the technology from that. So, does money move digitally every day? Yes. 60% of the money in the consumer side of our company moves digitally every day, and probably 98% of all the commercial money, corporate money moves every day, trillions and trillions of dollars. So the idea of a new currency need or a central bank digital currency or crypto, these things, they're really not going to change the system. It's a very efficient payment system. You can go anywhere in the world, you can hand people a piece of plastic and get dinner. That's a pretty fantastic system. So are there places we got to make it more efficient? Yes, but the purpose of the second part, the currency side, was something we were never interested in. The technology is kind of interesting when you apply it to certain types of transactions.
So you have not given up on crypto?
We've given up. We're not giving up on crypto. We never were for cryptocurrencies. What we were for is the blockchain technology, and those are two vastly different things. Yeah.
Well put. Brian Moynihan, very good seeing you again. Have a wonderful holiday. Brian Moynihan, the CEO over at Bank of America, has had an uncannily prescient view of this economy and was not doom and gloom when everyone else was. We'll see how well that pans out because the corner wall and broad, more sellers and buyers today. Again, we're talking about 1,000 points in the last couple of days. 28 of the Dow 30 stocks taking it on the chin. We'll have more after this.